Today I would like to analyze Chipotle, one of the largest restaurant chains in America and one of the worst performing stocks this year. The stock price is down around 26%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 59.05 billion US dollar. This makes Chipotle the second largest restaurant chain in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 5.98 billion US dollar. This was a decent growth around 7% from 2019. In 2021, we saw very good growth around 26%. This is something we like to see. And in 2022, we saw the good growth around 14.4%. Then again in 2023, the good growth around 14.3%. And in 2024, again, the good growth around 14.6%. So overall, in the last 5 years, I think we had a very good revenue growth. So the check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.29 billion US dollar. This was a decrease around 25% from 2019, so probably related to COVID. Then in 2021, we saw the incredible growth around 189%. This is something we really like to see. And then in 2022, we saw the decent growth around 0.53%. But I think it's also understandable because the year before we saw the incredible growth already. Then in 2023, we saw the very good growth around 44%. And again in 2024, the very good growth around 23%. So overall, I think we can also say we had a very good free cash flow growth in the last 5 years. So check here. The next thing we're looking for is the free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024. This is around 1.51 billion. We're going to divide it with the current market cap, 59.05 billion. And then we're going to get the free cash flow yield for 2024, and this is around 2.55%. And I think this is not a very high free cash flow yield, it's under the 4%, so it's not a check here. But we can also take a look at the future free cash flow assumptions. We can see here in 2025, the free cash flow could be around 1.51 billion. In 2026, around 1.43 billion, and in 2027, around 1.76 billion. So let's assume for 2027 around 1.76. Then we're going to divide it with the current market cap, 59.05. And then we're going to get a free cash flow yield with our free cash flow assumptions for 2027. So the number we're going to get would be around 2.98%. And in my opinion, it's still quite low, it's still under the 4%, and it would not be a check here as well for 2027, so we don't really like to see that. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years, a very important number because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. We can see here around 4.26 billion. Then we're going to add the short-term debt as well. We can see here around 277 million. And then we're going to divide it with the current free cash flow. So this is around 1.51. And then we're going to get the debt to free cash flow ratios that we're looking for. So the number we're going to get would be around 3.01. So I think this is quite a good number. It's under the 5 that we're looking for. So it's a check here, and it means in a little bit over 3 years, we can repay the debt with a free cash flow. We can also take a look at the cash on hand, how much money this company has in the bank. And we can see here around 1.42 billion. And I think that's a very good amount as well. So overall, I think this company has a very good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. First, we're going to calculate the enterprise valuation. So this is the current market cap, 59.05 billion. Then we're going to add the debt as well. So this is around 4.53. Then we're going to take minus the cash, so this is around 1.42 billion. And then we're going to get the enterprise valuation, so how much the whole company is worth. So the number we're going to get would be around 62.16 billion. So now we're going to divide this number with the current free cash flow. This is around 1.51 billion. And then we're going to get the ratio that we're looking for, and this is around 41.17. And that's still quite high. We like to see that number under 25, so it's not a check here. But we can also calculate this number for 2027 with our free cash flow assumptions of 1.76 billion. Then we're going to get a different number, and the number we're going to get would be around 35.32. And this looks a little bit better as well for 2027, but still not a check here because the ratio is not under 25. So overall, I think it's still a high valuation right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially if we think the company is undervalued. So we can see here repurchase of common stocks, and yes, this company buys back their own shares. Especially in 2024, it was over $1 billion US. So overall, it's a check here. But we also need to consider that they're buying the shares back at a high price at the moment. So it's better if they wait if the stock price goes down and then buy back their own shares. Can Chipotle stock be a good buy right now? The stock price is down around 26% in this year. So let's start with a positive about this company. I think we had a good revenue growth in the last 5 years. I also think we had a good free cash flow growth as well, and this is something I really like to see. The balance sheet is also looking quite good, so we have a low amount of debt and a good amount of cash on hand. The free cash flow here around 2.55% is quite low in my opinion. We don't really like to see that. We like to see that number over 4%. And in 2027, the free cash flow yield could be around 2.98%, which would look a little bit better, but still under the 4%. So the enterprise valuation to free cash flow ratio is also quite high, around 41.17. We like to see the number under 25. So it's already an indication for overvaluation. In 2027, the number looks a little bit better, around 35.32. But overall, I think it's still very high. So I think this company needs to grow the revenue in a very high rate in the next 10 years because the valuation is still very high at the moment, and I wouldn't buy the stock right now. If you found this video helpful, don't forget to like and comment and subscribe for more content.